An error occurred. Wait a moment. Try again. All right. Try it again.
It says we're live.
All right. Hello, everybody. Welcome. Hello. David Kinder here, registered financial consultant and charter life underwriter, here with my co hosts, Mike Moffitt and Kurt Gibbs. We're going to have a very interesting conversation today. We were just talking about our show notes here today, and we're going to be talking about the Roth IRA and the Roth 401k and how it relates to the tax code and a lot of stuff about this stuff. Any initial thoughts before we get into all the bullet points that I've outlined?
Not for me, really. I think obviously interesting topic. Kind of in the news of not really of late, but when it comes to saving for retirement and different things, kind of a twist, I guess, that the government has put on us with Roth 401ks and things of that nature. So should be interesting.
I share Kurt's sentiment. I think that it is an interesting way to save, partially at least maybe for retirement, as far as how the tax code treats it, and well, at least how it treats it currently, and what it can be used for. As far as taking distributions out, pre age 59, without penalty necessarily, as long as you do it up to your cost basis. So I think it can be used it to some degree if done in the proper way, in the right way. The main drag on it, I think, is for high income earners and for people that want to contribute more than the limits, and that's really where some issues come in. And so we can get into that more though as we go through. But those are my initial thoughts.
Yeah, it is interesting that, and this is one of the things that we understand and what we share quite a bit is that usually when there's something with really good tax benefits and the government puts a limit on it, it must be good. And it's good in relation to taxes. And what's interesting about this is that when you compare eligible contributions to a 401k versus a Roth IRA, light years difference. You can put so much more money into a 401k than you can a Roth IRA. Granted, there's now a Roth 401k. We'll talk about some of the differences on that later. But what's interesting is I looked this up this morning just to confirm what I thought to be true, what actually was true, because I like being very factual, like to make sure I'm accurate. And this was created by not just Senator William Roth, but also Senator Bob Packwood. I thought that was interesting. I found that on Investopedia. And Bob Packwood, as we know, I didn't know he was known for this. Well, actually, I don't know if he's really known for this, but he was known for holding up the ad of MetLife in Congress saying, this is an investment. This is not about widows and orphans. This is an investment, and we're going to tax it as such. And he's talking about a MetLife ad regarding life insurance. And so he went to work to help really to kind of destroy the tax code on life insurance and reformat those things. And yet at the same time, he's working with Senator William Roth to create this other thing. I thought, well, why is that? And I've got it quoted. I've got a blog article, and I'll put it into comments or the video description below. I call it Roth IRA on steroids, ? And that's in relation to cash value life insurance. And at the time, I copied it from Wikipedia that basically they created the Roth IRA so that banks and brokerage firms, they can compete with life insurance firms with somewhat similar tax benefits. I'm like, okay, they're trying to level the playing field a little bit. But one of the things that's different, and you mentioned this, Mike, is there's contribution limits. You're based on your income. You have an income limit, and then you have a contribution limit. So based on your income, and it's a pretty low threshold by comparison. I did not look up the numbers for this year. I think it's like 150,000. So it's not a bad threshold for most people. But based on your income, you can only contribute so much. I think the limit this year, I think it's 6,000. Could be wrong. I really should have had that printed out and prepared in advance. But the main advantage of a Roth account versus a cash value life insurance policy is that with a Roth account, you don't have to keep making ongoing contributions. to keep the thing in force. Whereas with life insurance, to keep the tax benefits, you usually have to keep making payments into it at least for 7 years. In fact, it's actually called the 7-pay test. And so if there's an advantage, that's the advantage, that you can contribute to a Roth account and not worry about making further contributions. And it's not going to destroy the account and what you've already put in. But if you
No.
start a life insurance policy and then you don't put anything else into it for a number of years, the policy can eat up your cash values and could lapse. So there's a little bit of a different mentality of how you manage that. Mike, you got a thought there?
Yeah, well, I was just going to say, as far as the contributions go, so for a Roth IRA, it's 7,000 for
Okay.
us. Yep, and for those under 50, and for those that are 50 and older, for the catch-up is 8,000.
Okay.
And
Which is
then,
an additional 1,000, not an additional 8,000. I want to make sure that
correct. Yes, and then for single filers, must be under 146,000, and then for joint filers, it's under 230,000.
Okay, yeah. So it's a pretty healthy amount of people that will cover. Used to be much lower, but those limits have increased along with the tax code and other limits. But what's interesting is that when we look at the tax code as it applies to the Roth IRA, it almost completely mimics the tax code as it relates to cash value life insurance. It's very interesting how closely mirrored it is, other than the fact that life insurance does not have an income limit. It does not have a contribution limit. Granted, once you set it up, you've got your parameters once it's set up. So, for example, you have a $1 million death benefit. You need to be putting in maybe 10,000 or more per year. Depends on how it's set up, company, all that stuff. Or maybe it's 100,000 a year. Again, depends on other factors. But yeah, it's modeled after life insurance for the tax, almost exactly. And why? It's to let the banks and brokerages compete on a somewhat equal level, which, okay, that's not too bad.
Well, David,
you got a thought there, Kurt?
Yeah. I mean, it's funny to me how the government, it seems like we continually try to rebrand, if you will, and modify everything that deals with how a person is going to save for retirement or save money or what type of plan that they want to create that really ultimately benefits no one but them in the end. And I say that kind of because if you think back about the tax code and how the tax code has been really somewhat very little changed, except for, the rate of tax going up, the calculation and how they do it. But, there for so long, what we had modified adjusted gross income, and then we have adjusted gross income. It's just a continuation to me of how the tax code continues to work against you if you're really wanting to put away X amount of dollars out of your paycheck, or if you have the ability to put even more into what they will limit you to put into a plan such as this. It's just I could get on my soapbox about it for a long time. It's just this government control of, you tell me how much I can put into something, not what I want to do. It's always about them and how much they control and how much they're going to let you, take out on a tax exempt basis or a tax free basis, or how much you can contribute to the Roth side versus the traditional side. There's so many variables in there within these plans that they've actually created, and I'm not sure exactly when, the Roth 401k, for instance, was kind of really put into play. But I do know a lot of employers now, that's all they're kind of offering to new employees as they come in. But in the end, it's still a revenue collection for the federal government, and the only way they can do that is some form of taxation, whether that be through your plan contributions in the form of limiting you to what's yours and limiting what you're allowed to take out. It's just once again just the government control that I despise.
Well, go ahead.
And let's give the government a slight bit of credit. And I hate saying those words, but we're going to do that for just a minute. The idea is you shouldn't be touching your retirement savings. It's meant for retirement. And if we think by comparison of pensions, you had no access to your pension But granted, you weren't putting your own money into pension. The company was putting the money into pension for you. So when we're looking at defined contribution type plans, which an IRA is technically not a defined contribution, but it acts like one. Yeah, the government basically wants to put teeth in there that basically says, leave this thing alone until we say that you should be able to get it. And it's part of the retirement crisis, more or less. Are enough people saving for retirement, or they have to be dependent so much on Social Security, which is a whole nother aspect. But let's talk a little bit about 401k matches, because so far I have not seen, and I might be wrong. I'm okay being wrong. So if anybody has the proof, share with me that I'm wrong. But so far, the company matches on a Roth 401k are done on a pre-tax basis, while the employee, the participant, is putting their money on an after-tax basis. And if we think about it from a company perspective, the company wants to maximize their immediate tax benefits in that year, which means they've got to be able, if they want to deduct it, it's either going to be deducted as a contribution to a retirement plan, which is deductible for them, or it has to be as salary to the participant to then be deferred. And I can't see any other way of doing that under the current law. Now, if it could be deducted as an after-tax contribution, hey, that would be wonderful, but I don't think the government's going to do that. And when we think about the amount of debt this government has incurred, our government, we put these people in there. Just saying, but they're not going to change that anytime soon. The only thing that's really triple tax-free is a health savings account, tax deductible contributions, tax deferred growth, and you have tax-free withdrawals for the purpose of medical expenses. That's the only thing that's out there that's completely triple tax-free. Otherwise, you can have 2 out of 3, but you can't ever have 3 out of 3. So you either have your deductible contribution up front, or you have your tax-free benefit on the back end. It depends on which levers you want. Again, 2 out of 3, you just can't have all 3. And so unless the company can have an actual deduction, why would they offer it? I don't see them doing that. I don't see the legislation going through on that. I don't mind being wrong. If someone's doing an after-tax contribution from the employer, I would love to see that, which means that you still have to deal with taxes from a Roth 401k. In addition, and this is something we didn't talk about last week, because we talked about qualified plans. And with qualified plans, there's a vesting schedule on the employer match. And the most traditional method of the your dog really doesn't like this vesting schedule here, Mike. I'm just saying.
It's every time we talk about qualified plans, he goes berserk.
She knows what's going on, and she's like, don't you dare talk about pre-tax things.
Don't we do it? Listen to this is the warning here, people. That's it. So,
the dog knows.
The dog knows. So let's talk about the most common vesting schedule, which is a 5-year vesting schedule, and usually it's 20% per year for 5 years. So after the first year, you get to keep 20% of what your employer put in if and when you leave the company. If you're there for over 3 years, you get to keep 60%. You're there over 5 years, you get to keep 100% of the match that was contributed. So that's why if you left before the end of 5 years, you only got a portion of what was contributed. You don't get the whole thing. And so with vesting, that's one way that the company, think about this, the company gets to make a tax deductible contribution, but then if you don't get to keep it all, they get the difference back. Now, they probably have to recharacterize that and say, well, that's now income back on their balance sheet, but that's a cost savings measure. In a way, if we think about it, it's a golden handcuff, employee benefit vesting. That's what it literally is, in order to get people to want to stick around. I heard you breathe there, Kurt. You got something. Okay.
Well, it's just how complicated can we continually make saving money? I mean, really, how do we the government wants to continually hold their finger on you and complicate things so much that they don't even understand it, number one. Number two, you as the consumer are honestly clueless about the last 3 to 5 minutes that you've just sat here and talked about this, because it is so complicated. We have made it to where that it's just plan administrator, sign here. You got 25 funds to choose from. You can go on the Roth side of it. You can do this. There's this amount of money that you can contribute to it on a this level of taxation, and this part. One day you'll get hopefully tax exempt. Who knows? That's going to be up in the air as things change. But it's just it just kind of elevates your blood pressure when you stop to think about how complicated that the system has become, and how that it just continually is a tug against you, not in your favor.
Yeah, and what's also interesting is how many IRS publications there are that talk about all this stuff. And in fact, recently, I don't remember exactly when they did this, but IRS publication 590 was all about IRAs. Now it's 2 publications. You have 590A for contributions. You have 590B for distributions. And they're all, in fact, I've got 590B up. It's 70 pages for that one. The other one, I'm sure, is just as many pages. I'm like, geez, how many more hoops and challenges do we need in order to secure a tax deductible benefit with a government that's probably going to mismanage it in the first place? Okay, there's my little political rant there.
Well,
but,
we're 30, as we sit, we're 30 whatever $trillion in debt. And you're going to see, just what you mentioned, publication A, B through, it's going to be extend the alphabet before long, because there's no way to recoup and to get revenue other than the taxation side of it, and how they can legally, if you want to call it legal, go in and really put their finger on you to where, hey, you're going to get X amount of dollars that we'll let you put into something, and anything above that, we're going to get a piece of. It's just frustrating, very frustrating.
Very frustrating. In fact, I have the U.S. Debt Clock website. So this is real time as of today, $34.8 trillion. Now, at some point, we might actually be talking about real money. But let's go back in time. Now, this is really neat. In the time machine section here, we could go back in time. What was it in 1980? Now, 1980, if we go back in time, we had Jimmy Carter. It was the election year for Jimmy Carter, but that's what we had. And at the time, we talked about this last time. I think it was last week. We talked about the tax code and what was the tax brackets. And at that time, the top tax bracket was 70%. So at that time, we were barely under $1 trillion as of 1980 today, according to the website here. If we go forward to 1990, of course, we had Reagan, we had Bush, and it tripled. Look at that. It went from 1 trillion to 3.3. Now, a lot of people say Reagan was the greatest president ever. Well, not according to the national debt. He increased it by the greatest percentage than any other president since him. So I want to say that there's some issues there. And I want to try to we can be critical of our government, but this is not a Republican thing. This is not a Democrat thing. And I like quoting what Tom Hegna says. This is a math thing. And the math is going to show us some other things here. So 1990, 3.3 trillion. And if we go forward to the year 2000, we had Clinton, and obviously 2000 is an election year. It only went to 5.5. So not quite doubled from the 3.3. Not too bad. I got to give Clinton just a little bit of credit there. All right, now we go forward to 2004. So now it's broken up into election year or presidential terms. We go from 5.5 to 7.8. Not quite double, about 50% in 4 years. And then we go to 2008. And of course, 2008, the beginning of the biggest the recession here, went to 11.7. And we just see this thing increase and increase. 2012, again, we've got, President Obama. Now we're at 16.5. And at this point, we probably have signed in the Unaffordable Care Act. And then we go to 2016. So we went to 16.5 to 20.7. And then we look at 2020. So 2016 to 2020, yeah, that was massive. A massive amount. And you might say, well, that was Trump's fault. Well, keep in mind what happened in 2020. We started spending everything on COVID and on vaccines and tax benefits and all this stuff. But that was only 28.2. Now, if we go to present day, 2024, we're at, come on, computer. Okay, 34.8. And according to current spending trends, what does it look like for 4 years from now? It says for 2028, 46.4. So we add another 12 trillion in 4 years, according to current spending. This is a problem.
Well, you know, David, the thing of it is, you as the consumer, and you know, this is conversation not geared toward the agent side of things, or for those that are, you know, out there listening, but you've got to stop your bleeding of your plan, so to speak. You know, the government's going to spend what they're going to spend. We're not going to control that, but we've got to stop the bleeding on a personal level, and become more aware, more educated, about the strategies that are out there that will benefit you far greater than the institution that is offering you a 401k Roth, or a traditional plan, or a match plan. Because in the end, you know, just kind of what was tapped earlier, was that it's to benefit those institutions, not you. So take advantage of the education that's out there, whether it be from us or someone else, about ways that you can be an advocate for what you're doing that's in your best interest, and not in the best interest of the government, because they're going to spend what they're going to spend, and you know, that boat's going to continue to sail to some degree, but it's going to highly depend on how much you contribute to that, whether or not it's you know, in your best interest.
Yeah, and this is a good time. I'll point out our logo here for the Financial Advocacy Podcast. And obviously, we got some nice bold lettering and such on front, but it really shows Wall Street, banks, and the IRS. And by the way, we'll talk about insurance companies too. They're part of the whole cabal of financial stuff, because their plans as institutions and as governments is: we want your money. We want it on an ongoing basis. We want to hold on to it for as long as possible, and we want to give back as little of it as we can get away with. And that's their mantra, unless we could figure out a way to turn it to make it benefit us. I truly believe that you, as the American public, have the fundamental right to be the primary beneficiary of your life's work, of your financial retirement planning. And if we can help you to turn this around using the tax code, by understanding the tax code, realizing where we've been, and here's what's available, would you like to see what those consequences can look like? And we just map it out and find out. Let's see what happens.
Well, you know, all these plans are geared toward, you know, accumulation phase of money, and you think that that's the most important thing for you, but I would argue that the most important phase for you is obviously the distribution phase, because whatever you save, you want to spend. I mean, that's the whole
Mhm.
premise around, you know, saving for quote unquote retirement, whatever that looks like to you. But the accumulation phase, far greater benefits, when we're talking about what we're talking about with, you know, qualified plans last week, and what we're talking about on the you know, the Roth and different things now. It benefits the institution far greater than it does you during this accumulation phase, and that's where they're gonna, you know, drag their chips off the table, so to speak. You know, it's just much better way to distribute your wealth, which is what you want, with other products and strategies out there that have been around for, you know, as we know, 100 plus years. That we didn't have institutional investment stuff going on way back, you know, in your great grandparents' day and your grandparents', you know, time. It was just there was smarter ways to save money then, and it stands true today. We've just gotten away from that.
Yeah, we absolutely have. And there's so much information that's out there that's not necessarily factually accurate, or that characterizes everything the right way. So, for example, and this I love questioning advisors and agents on this one. You guys know the answer to this, but let's see if we have anybody that wants to put something in the chat here. But what does the A in IRA stand for? And most people have no clue. They think it stands for account. It's an individual retirement account. And strangely enough, the government actually has it right. It's not an account, it's an individual retirement arrangement. So even on the publication, the IRS has it saying these are individual retirement arrangements. And by the way, for the pro annuities, it does not stand. The A does not stand for annuity either. Sorry, it stands for arrangement. And so, who dictates the arrangement? The federal government and the IRS. Congress.
Yeah,
Who
and
sets up all the terms? Go ahead, Kurt.
yeah, and and you guys, every state is different in some capacity, but you guys have two states that I don't read too much into this because obviously it doesn't apply to me, but you guys are in two states that have obviously got state pension problems, that have been propped up by, government funding and the source of that. I know, Mike, there's a lot of talk in the news about, what's been going on in the state of Illinois with, the state programs and different things of, not being funded. And that's, those are tax dollars that are having to prop those things up. So where are those going to come from? They're going to come from, it's a trickle effect of things that we're sitting here talking about.
I actually have a clip. Fox News, Fox Business, Varney, I think it was. This was like 3 years ago, saying that they're going to tax 401k distributions in Illinois. Now, keep in mind, Illinois does not have an income tax on 401k distributions. They're kind of unique that way. For California, we definitely do. But Illinois doesn't have that. And they were going to propose a tax on 401k distributions to help shore up their pensions. So the financially responsible are going to bail out the state that was not able to be financially responsible. How do we feel about that? It just makes me cringe just to think about it. Yeah, that's a problem. But anyway, going back to the arrangements, who's dictating it? Who gets to dictate the terms of the arrangement? Who gets to say how much of it that belongs to them? Basically, in these arrangements, you are the silent partner. And you don't get a whole lot of say other than who do you vote for in Congress. And by the way, again, both parties, they're both just as guilty as we've talked about. But you're in an arrangement to figure out how much of your retirement savings does this government, who's been spending that money, gets to control of your plan. The financially irresponsible gets to dictate how much of your financially responsible decisions they get to take. That just irks me to no end.
Yeah, and the other thing is that an arrangement is different than a contract.
Yes.
An arrangement can be changed at any time. So they can change the rules and the way they tax things and whatever they want at any time because it's an arrangement, not a contract. So it's totally different than contract law.
Absolutely. And in fact, we go back in our history on that. Back when Bob Packwood raised up that ad and said, we're going to tax this as an investment, regarding life insurance and such. All that they did, they made new contracts as of a given date to have a certain structure to keep their tax benefits. They actually made it better. And everything that was before that given date was grandfathered by all the old rules. So one of the things that we're taught, and it should be in everybody that's an insurance licensed agent, they should know to keep in mind the 1980s, especially 1986, 1988. I don't even remember the exact dates, but if you're reviewing someone's policy and they've got a policy around that time or earlier, double check the effective dates. Don't replace that thing, because that could be a gold mine, particularly regarding taxation on that. So we got to be careful. I just know enough that if those dates show up, I'm going to double check and make sure before doing anything to disrupt that contract. To me, those contracts are essentially sacred. We want to preserve that as long as possible. Which brings me to now, if we're going to talk about, taxes and everything, well, what could be done regarding tax? Now, by the way, I'm going to bring up Brian Summerfield. He again, our friend and accountant here in Florida. Most taxpayers do not know that paying income taxes in retirement can be made optional based on where they put the retirement dollars. There's a big variable in your planning that can be controlled. So, and absolutely 100%, it's not just, we often talk about where you live. You vote with your dollars, right? Well, you can vote with where your money lives, not just where you live. So if you wanted to, And quite frankly, yes, California has plenty of problems. I'm not planning to leave though, because I'm in the problem solving business. What if you can stay in California and not contribute any further to a failed government policy? Wouldn't that be something worth talking about? And all we have to do is siphon money from where it would be forever taxed, move it to where it would be never taxed. And we do it again, factoring all of the taxes, because that's not necessarily a tax-free process. But if we do that, we can make sure that we limit how much you're contributing to this, and you can still stay where you want to live. So
This is
the next, yeah, go ahead.
no. I'm just sitting here while you're talking. I'm just sitting here looking at this debt clock, and we're basically adding $1 million in debt a second.
Oh, gee, don't put. Oh, you're scaring me here. You're scaring me here, Smalls. Okay.
Well, the thing of it is,
There it is.
we've come to realize that as a country, as investors or as savers or whatever you want to label yourself as, that this debt clock, for instance, to most people think nothing about this. They just continue on with their day. They put their match into their plan, and they hope that 25 years down the road that it's got enough money in it for them to supplement their Social Security if there's going to be social. That's obviously a topic for another day. But it's just amazing to me how little most people pay attention to what's really going on around them with their money. So many better ways, not just one or two ways. There's a multiple ways to do things differently that you do not have to have the government controlling any of that. We've got to be smarter. We've just as consumers, we all have got to be smarter. We've got to get better educated, and that's why one thing I just really gravitate to about the group that we're a part of, and how we do things differently. And I'll argue that with anyone, and we can prove everything that we do systematically, mathematically works to your advantage and not the government's advantage.
Absolutely, 100%. I wish I could give a thumbs up on that, but yes, absolutely. Now, the next part I want to talk about is actually managing it with Social Security. And here's what's interesting. I went to go find today the provisional income formula for Social Security, and they took it down off of their site, from the Social Security Administration site. It is gone. They put in here, you could manage the Social Security benefits and actually, it wasn't even this one. What was it? It was the withholding taxes. That's where the link went to, as opposed to showing the provisional income formula. It's saying you can withhold taxes from your Social Security to pay your taxes, which, if I put my conspiracy theory hat on, means the government's trying to convince us that we don't need to know the calculation so they can change it later on us. Again, conspiracy theory hat, but it's still going to be in line with what I'm going to share with you here. So I had to find the link. By the way, the history of this, I have a history of the taxation of benefits. In 1983 was the first time that, and again, this is under Ronald Reagan, was the first time that Social Security was included in your taxable income if you had other income above a certain amount. And there's different thresholds and everything. And so 1983 had the 50% threshold. Then we go further into 1993, and it added in the 85% threshold. And that doesn't mean it's an 85% tax where they'll take all of it. What it means is that 85% of your benefit will now be added onto your current income to figure out how much of it you're going to be taxed on. So it's just annoying to see that. And by the way, those limits have not changed since they were originally put in place in 1983 or 1993. They have not been indexed to inflation, which means more and more people are going to have their Social Security subject to taxation. And originally, when it came out with the New Deal, it was never going to be taxed. It was always going to be a contract with America. It would always be tax-free. Well, the fact that I couldn't find that link, I had to go to the Internet Wayback Machine and find it. And you can see it was there up until a few months ago. Looks like April. It was archived then. But here is the formula. I want to talk about this because this is where I'm seeing a past precedent and how it can apply to the Roth IRA or Roth 401k. You take your adjusted gross income, You add non-taxable interest. And then you add in half of your current Social Security benefit, and it becomes your combined income. This non-taxable interest is municipal bonds. The municipal bond income is tax-free. You don't pay federal taxes on it. But what do? They say, well, you can have that as tax-free, but for your Social Security, we're going to add that into the calculation. So you're not going to have wealthy people with a ton of municipal bonds keep non-taxable interest and still keep all of your Social Security. We're going to tax that one way or another.
Speaking of your Social Security, I want to share this with everyone out there that finds this or listens to this. And as you guys well know, we have a couple of 2-3 key questions that we ask, people that we sit in front of to kind of get the conversation started. They're basically yes questions. And if you, answer those correctly or honestly, and, the answer being yes to all 3 of those, then, we continue the conversation. Spoke with a gentleman yesterday that was really fascinated by his answer to this, and it is very simple. It's so simple that you don't think about it even. I asked him, the series of the 3 questions that we ask, and I asked him a 4th question. I said, now how much of your Social Security do you want taxed? And he's like, my Social Security is taxed. And I go, yeah, based off of what you've told me so far, before we had the initial conversation about the amount of money, the dollars that you're wanting to withdraw and the things that you're, hoping that you're going to be able to do at retirement age, their portion of your Social Security is going to become a tax issue. And he said, I've never been told that. He said, I was told that I was going to be in a lower tax bracket when I retire. And we all know that's the trigger question of what's really been a topic for us lately, and within our group of, do you really understand what that means? Do you really do you want to make less money in retirement? It just really brought up a fascinating conversation with him yesterday when I simply asked him, well, okay, now how much do your Social Security you want taxed? And he's like, well, none of it. And I'm like, well, then what you're doing is not going to get you there. The plan that you're contributing to and the amount of money that you're hoping to withdraw, on a monthly or an annual basis from retirement proceeds they're not gonna do anything but cause you to have an increase on your taxation in retirement. And he's like, I don't want to do that. And so it's amazing how just a few simple things that maybe we as advisors that know the answers to take for granted on the questions that we ask people. I think that's how little we know about what's going on within our own plan.
And it becomes an intimidating topic too for some. I think about married couples, and typically in a married couple, one person is the financial person and the other person isn't. And the other person that isn't only wants to feel comfortable with whatever they're going to be doing, but they don't understand it. It's Greek to them. It's really it's a foreign language to them. And unfortunately, I think they're the ones that will probably be more victimized by the tax code, victimized by the financial institutions, as opposed to being positioned and set up for success. And
and even on the Social Security, topic there, I don't know that it's as much a paperless savings for the government or whatever. But when did a lot of people are just unaware that they're like, why did they quit sending out paper statements? You don't even get a statement from the Social Security, anymore. It's just to me, it's just another way of not keeping you in the loop, so to speak. I mean, we can send out mass mailers for every kind of piece of junk mail you get, but the government can't send you out a statement once a year, to define, what's in or what's available in your Social Security. It's just another government infringement, if you ask me.
So I think it's still available. I think once you turn 60, they can give you the option for paper statements.
Okay.
I remember there being something like that. But don't quote me because I can't remember. I, of course, signed up for paperless because I get everything paperless, and I don't trust mailboxes because you never know who's going to steal stuff from your mailbox. And we've had that happen a few times. But let's go back to this non-taxable interest. Municipal bonds were tax-free interest on a federal level. They included that now into taxing your Social Security. What about the Roth? Looking at how much our government is spending, doesn't it make sense that at some point they're going to say, you know what, we'll keep the Roth federal tax-free, just like municipal bonds, but we're going to include your Roth as a distribution into determining if you're going to pay taxes on your Social Security. And they can do that for a couple of reasons. One is that obviously balances are reported to the federal government every year. It's all tied to our Social Security. They already get that. But every time you make a distribution from a Roth account, it's shown on a 1099 form. It's disclosed. And with that disclosure, they're going to see, do you really need this benefit? They're going to think, one, can we tax it? And two, do you even need your Social Security? So it's not just increasing taxation. They might even make it a means-tested program that basically says you made too much, you've got too much wealth, you don't need it anymore. And who might that be? That might affect, I would think, the top 10% of income earners. Now, who makes up the top 10%? The top 10% of earners are about $105,000, $110,000 household income per year. If I go to, and I didn't plan on showing this, but let me go to my consulting resource. I've got it for wage statistics. And so I'm going to pull that up here. Wage statistics for, let's pull it up for 2023. No, that won't be in yet. 2022. That'll work. Now, this is a hard chart to read, but basically everybody that is under a certain bracket is how much percent of the total. So when we go to 90%, we're right here at 90.3. Okay, now it's 120,000 or more. If you earn 120,000 or more, you're in the top 10% of income earners. Is that enough to be targeted by the tax code that says you don't need your Social Security? It might be, I don't know. But that's 10%. If we go to 5%, we got, let's call this 94.9. So that means 5% remaining. That's 165,000 plus per year. Guys, that's not that much.
Well, David, the government, I mean, obviously they know exactly who falls into those categories and the areas that they can target the most. And that's what that's going to be about eventually. And you pointed it out, where do you fall in that spectrum is going to probably dictate how they label the tax of what they're talking about doing eventually. I think it's on the table behind the scenes that we just don't even know about already. Why else would they want to know on your tax return if you contribute to a Roth IRA? They don't necessarily want the dollar amount right now. They just want to know if you contribute to one. Because there's going to be some way that they figure out a way that they're going to be able to tax, that the same way they do everything else. It might not be quite worded that way as a tax, but it may have something to do with Medicare or your Social Security. But it's definitely not just talked about. It's going to become a reality, I think, sooner than later.
Yeah, the current tax law is that all of the distributions from a Roth do not affect anything in the tax return, but it's still disclosed. So yes, I believe at some point it'll affect your Social Security benefits, whether you get them or not, or it will at least affect how much it will be taxed in the provisional income formula. It may, as another ripple effect, affect your eligibility or how much you pay for Medicare. And we haven't talked about it much, but the Medicare income-related monthly adjustment amount, IRMA, is all based on your reported income and whatever they count as income. So it will affect how much you pay on that. Go ahead, Mike.
There's actually, in Medicare, there's actually two IRMAs. There's
part B and part D, right?
Part B and part D, right? So
yeah, you probably see this. You probably see this a lot, Mike, with your extensive background in the Medicare side of things. You probably have to explain that to people that don't understand how that really works.
Mm-hmm. Yeah, a lot of people aren't even aware of it until they get either billed for it or I'm quoting them a coverage and they're asked about it and they have no idea that there's even an IRMA is what it's called, Part B IRMA, like Kinder said, income related monthly adjustment amount tax that can be taxed on your Medicare benefits. So it generally really only affects higher income people in general. For the most part, I would say that the vast majority of people probably don't have to worry about it, but it is there. And if they don't change that number and inflation and things keep going the way they are, or if you have enough money, it could be a big deal down the road. A lot more people could be subject to that tax. So, or they could even lower the amount that they're going to tax it for. Again, they can do whatever they want with this stuff. It's totally up to them. And if they need to raise more money for Medicare, that certainly would be one way to do it, is to lower the income threshold for the Part B and the Part D IRMA. I mean, there's nothing stopping them from doing that. So
right. It's so far it's kept pace with inflation. It does increase so far, but they could just change it, cut those limits in half if they wanted to. And when I look at the limits and the amount that they're being charged compared to their income, it's not like they can't afford it.
Right.
It's just a real annoyance.
Right.
It's just annoyance. And why are they doing this? It's still another what we call a success tax. You have more income. You were able to succeed in America. Therefore, government says you're going to pay more. And I love sharing it like this. I talk about it like you go into the dealership. You've got a Toyota Camry, 6-cylinder engine, and you want an oil change. And the normal standard price for an oil, although maybe it's gone up, but it's probably $100. But the dealer figures out, oh, you've got great credit and you've got a lot of money. We're going to charge you $500 for the exact same oil change. And like, gee, the service didn't change. You're not getting different benefits. You're just paying more for the exact same stuff. And that annoys me. In a capitalistic system, it's not supposed to be that way. However, this is not capitalism for healthcare. Essentially, it is socialism, and the government gets to mandate who gets it and how much they're going to pay for it. And yet you can't necessarily, although there's Medicare supplements, and Mike, you are far more the expert and well-versed on that stuff. I've never even done CMS training on all that, but still, it is a government-mandated, government-regulated plan, and it's priced as such. And how annoying that is. And yet there's a way around it legally using the tax code. It doesn't have to be that way. And yet what's interesting is that when we look at the IRS publication 590A and B, there are some prohibited transactions. I want to bring this up because one of the things that we like to advocate for, and sometime we'll have a separate podcast on this, is we like to advocate for the use of collateral. Basically, collateral is using someone else's money backed by your own assets. But the thing is that if we look at, I'm going to share my screen here. Oops, I'm hearing that. Whatever that wasn't me. Here we go. Now I'm quoting from my own blog, but I quoted in my blog from the IRS publication. And what it says, prohibited transactions. There's some examples of prohibited transactions with the traditional IRA. They also extend to a Roth IRA because it's the same tax code. It's IRS section, Internal Revenue Code section 408. And you cannot borrow money from it, and you cannot use it as security for a loan. And if you happen to do that, it will the account stops being an IRA as of the first day of that year. So what does that really mean? What's the effect? Well, you might think, gee, if I can't withdraw money tax-free, could I pledge it as collateral and get someone else to borrow money from them, use my IRA as collateral? The government's pretty smart. They said, no, you're not doing it. We won't let you do that. So one of the largest assets that most people have is their retirement funds. You cannot pledge it as collateral. You can pledge almost anything else you want as collateral. You can have a portfolio of securities that are eligible. Usually they're blue chip types of securities. You can borrow against that. It's a margin account. You can borrow against your home, either through home equity loans or a refinance of your first mortgage. You could do a reverse mortgage if eligible. You could borrow against commercial property, business buildings. I think I'm missing one, but that sounds about right. But you can borrow against life insurance. But you cannot borrow against your retirement plans. You cannot do it, or it's you sacrifice that status in that year. And for Roth, the main difference is that you won't have tax-free growth going forward. If you happen to do that with a 401k or an IRA, everything becomes taxable that year. That becomes a huge problem. So we actually had someone, I think the leader of our financial group, he shared a story of a client who went to try to get a loan against their IRA, and they complained that their bank said no. And he said, no, you should be thankful because you would have sacrificed every tax advantage you have with that. So So sometimes you look for what's the workaround. The workaround isn't there. You'll end up forfeiting your current status of the account in the year you do it.
Yeah,
So,
and just to touch on this a little bit about just like access to money within your plan and taking loans out of it and different things that you can and cannot do with these plans. Use a little common sense and just think about what's good about a plan that I only have a 10 or 11-year window that I can do something with those funds with. I can't use those throughout my lifetime. I can't use them for purchases if I need to. And if I pay it back, if I take a loan out, the thing that kills me the most, I guess, is you have people that take money out of a qualified plan in the form of the loan. They take it out at a tax rate, and they take it out and they pay it back with after tax dollars back into that plan.
mhm.
I mean, think about that, guys. That's not it's not a good plan. Not a good plan. It's not a good plan for you, but it's a great plan for it's a great plan for the government.
For the government and the plan
The
custodian,
institution,
the people
yeah.
that administer them, because they're obviously making money off the interest, and whatever you pledged in the 401k, the amount of the loan comes out of the securities, so you're not keeping your investment growing as it could have been if it was left alone. There's a lot of different things. So in the future, we'll talk about collateral. We're going to be talking about uninterrupted compound interest. There's a lot of other things to talk about. Um, but yeah, but the problem is, and I say it's the problem, but we're putting our own money into it. But once we put our money into it, it's not really our money anymore. Although the government will let you access it if it's under the hardship provisions. We talked about that last time. Or if there's some special natural disaster you're affected. I think of Hurricane Katrina and whatever else that has happened. The government will come in and let you have access to your funds. Gee, thanks a lot. We're here for the government. We're here to help. I mean, it's just cringy, especially when we're talking about your money. But the problem is we think of it as our money, but it's not. So a great question that sometimes we'll ask is, you bring in your 401k plan statement, and you say, and we ask them, how much of this plan belongs to you? Well, what do you mean? Well, let me word it another way. How much of this plan is yours? It's got my name on the statement. Okay. How much of it belongs to you? If you were to call the company and cash it out now, the entire thing, how much of it would you get? And usually the answer is they don't know.
Well,
And in
yeah,
doing that, yeah.
yeah. I mean, and the thing too is, I had the same conversation with the same gentleman that I mentioned earlier. Was you've max funded your 401k for 20 years, and you have the availability with which very few people even fall into this category any longer. But he has a defined benefit pension plan that has, I'll just throw a number out there that has, $600,000 of, of money available in it. And he, the question I posed to him, I said, well, why do you not have that much in your 401k? And he's like, well, I guess because it's went up and it's went down. And I'm like, yeah, I mean, so, why do you think we kind of have gone away from defined pension benefit plans? Because they were from a retirement savings stance, it's one of the better things, if not the best thing there was out there. And they introduced these 401ks. These institutions did, and they were never set up intentionally to be retirement vehicles for the average, person out there. So it's just another way that we've kind of not really necessarily been lied to, but we've just not explored some of the more uh, stable options, I guess you would say.
Yeah, well, of course, the more stability, the more guarantees, the more it costs. That's the more cash outflow that it requires. And 401k plans don't have nearly those kinds of reserve requirements that the defined benefit plans have. So,
Yeah.
yeah, that's a lot of the big reason. And that's one reason why. And again, we can still look at the fact that the government wants to incentivize that, which puts more money into the stock market. We could think about the stock market growth ever since the 80s and such, since the ERISA was put into play and most of the money being invested back into the market. Whereas pension plans are not necessarily invested that way. If pension plans are managed like life insurance companies, most of it is in corporate bonds and government securities and, treasuries and things like that. They're not necessarily going into the stock market. So it's probably been a great boon for the economy, but at what price? The more the stock market seems to go up, the more the government national debt seems to be going up. And at all of that, at what price? Something's going to happen at some point. So to wrap us up, my conclusion is that the Roth IRA is great until it isn't. At some point, I think it's going to be factored in through other eligibility plans, whether it's going to be means tested or just taxed in a different way. Roth IRA is great until it isn't. So that's kind of my stance on that. Just a quick acknowledgement. Hey, Alonzo, I'm glad to see you participating in here. That's great. And Prince, glad to see you too. Prince and Alonzo, they're my buddies. Call them, my brothers from another mother. Love those guys. So guys, we will catch you all again next week, and maybe we'll talk about uninterrupted compound interest or something. We got so much more to share that we're just exposing more of the patterns behind what's going on so we can help everybody make better financial decisions. So we'll catch you all next week. Thanks so much for attending.
Wait.
No,
1 second. I just have one last thing I wanted to share.
Bring it on, Mike.
Just real quick. I was just thinking about this. So if you really believe that taxes are going to remain the same, or you're going to be in a lower tax bracket when you retire, somehow, magically, why would it be that the government would let you put more money into a tax deferred account versus an account you're paying taxes on now? Over 3 times as much. You can put $7,000 into a Roth and $23,000 into a 401k, and not only that, the income limits are lower on a Roth than they are on a 401k. So if you really believe that you're going to retire in a lower tax bracket, like they tell you, why wouldn't they want to tax you now and let you put more money into the Roth instead of letting you delay it and put 3 times as much into your 401k?
Definitely something for everyone to think about for a week.
Things that make you go, All right. We'll catch everybody next week. See you then.
Yeah.
Thanks for tuning in.
See you guys.